This question examines performance evaluation systems and goal congruence in a decentralized organization. The company is concerned that divisional managers are making decisions that benefit their own divisions but not the corporation as a whole. Therefore, the performance measure should encourage managers to accept projects that increase overall corporate value. Among common performance measures, flexible budget variances focus on cost control and operational efficiency, but do not necessarily encourage long-term investment decisions. Operating income measures accounting profit, but ignores the amount of assets employed and the company's required return on investment. Controllable costs evaluate managers only on costs they control, but do not measure whether investments create value for shareholders. Residual income, RI, measures the income earned after deducting a charge for the cost of capital, making it a value-based performance measure. Because RI rewards managers for accepting any investment that earns more than the company's required return, it promotes goal congruence and reduces the tendency to reject profitable projects simply because they lower divisional ROI. A. Flexible budget variances. Incorrect. Flexible budget variances measure operational performance, but do not ensure that investment decisions maximize corporate value. B. Operating income. Incorrect. Operating income ignores the cost of capital and the amount of assets employed, potentially encouraging inefficient investment decisions. C. Controllable costs. Incorrect. Cost control is important, but focusing only on controllable costs does not encourage managers to maximize shareholder value. D. Residual income. Correct. Residual income incorporates the cost of capital and encourages managers to undertake projects that generate returns above the required rate, aligning divisional decisions with the interests of the overall corporation. Correct answer. D. Residual income. A residual income performance evaluation system promotes goal congruence by encouraging divisional managers to accept investments that earn more than the company's cost of capital, thereby maximizing overall corporate profitability and shareholder value rather than focusing solely on divisional performance. This question tests your understanding of residual income, RI, a widely used performance measure for investment centers. Residual income evaluates whether a division generates income above the company's required minimum return, cost of capital. Unlike return on investment, ROI, which measures a percentage return, residual income measures the absolute amount of value created after covering the cost of invested assets. The information provided is: a investment equals AD 1 million. A net income, year 1, equals AD 250,000. A required rate of return equals 10%. First, calculate the required return on investment. Notice that the sales revenue of AED 720,000 is irrelevant to the residual income calculation. Only investment, required return, and operating, or net, income are needed. A positive residual income indicates that the division earns more than the company's minimum required return, thereby creating value for shareholders. A. AED 100,000. Incorrect. This is the required return on investment, not the residual income. B. AED 150,000. Correct. The division earns AED 250,000, exceeds the required return of AED 100,000, and therefore generates AED 150,000 of residual income. C. AED 225,000. Incorrect. This amount is not derived from the residual income formula. D. AED 620,000. Incorrect. This is unrelated to the residual income calculation and appears to involve sales revenue. Correct answer. B. AED 150,000. This positive residual income indicates that the new division is expected to generate returns above the company's required rate of return, making it a value-creating investment. This question tests your understanding of return on investment, ROI, and the measurement of assets used in calculating ROI. ROI is one of the most common performance measures for investment centers. Because ROI depends on the value of assets in the denominator, the method used to measure assets can significantly affect divisional comparisons and manager bonuses. When comparing divisions, the asset measurement method should provide a fair and consistent representation of the economic resources employed. Using historical cost or book depreciated value may distort comparisons because older assets have lower carrying values due to depreciation, artificially increasing ROI even if operating performance is unchanged. Similarly, depreciated cost can make older divisions appear more profitable than newer divisions simply because their asset base is smaller. Using current cost, replacement cost, reflects the current economic value of the assets used in operations, making comparisons across divisions more meaningful and reducing distortions caused by differences in asset age or depreciation methods. Thus, for performance evaluation and bonus determination, current cost provides the best basis for comparing divisions. A. Book value. Incorrect. Book value depends on accumulated depreciation and can make older assets appear more productive than newer assets. B. Current cost. Correct. Current cost measures assets at their present economic value, providing the most consistent and comparable basis for evaluating ROI across divisions. C. Historical cost. Incorrect. Historical cost reflects original purchase price and ignores changes in asset value over time, reducing comparability. D. Depreciated cost. Incorrect. Depreciated cost, net book value, decreases over time, potentially inflating ROI for divisions with older assets. Correct answer. B. Current cost. Using current cost as the asset measurement basis provides the best method for comparing divisional ROI because it reflects the current economic resources employed, minimizes distortions caused by asset age and depreciation, and results in fairer performance evaluation and bonus determination across divisions.